Over the last few years, trillions of dollars have surged through global artificial intelligence and crypto markets, creating immense wealth at breakneck speed. But for investors looking for those same opportunities within the Philippines, the momentum hits a dead stop. Since 2013, the country's exchange-traded fund market has relied on a single product, the First Metro Philippine Equity ETF. For over a decade, it has sat alone, tracking the same 30-company index without a single new competitor joining the board. That isolation is ending. The Philippine Stock Exchange is moving forward with a proposal to overhaul the current rules and revive this stagnant ecosystem. Local retail appetite for new assets is high, but for the last 10 years, that capital has been trapped by a regulatory framework that prioritized stability over growth. The bottleneck was capital. Legacy rules required a baseline capitalization of 250 million pesos for any ETF, restricting the market to large banks. Structurally, it was also inefficient. Issuers had to incorporate a new company for every single fund launched, multiplying legal and administrative costs. These legacy rules were designed for a different era of finance, and they effectively barred smaller, more specialized fund managers from offering new choices to the public. The exchange is moving to lower the cost of entry. Draft rules reduce the 250 million peso capital requirement to 50 million. For established companies with a 5-year track record, it drops to 1 million pesos, allowing boutique firms to compete. The PSE is also introducing the umbrella structure. This allows a single manager to launch multiple sub-funds under one issuer, removing the need to build a new corporation for every idea. By lowering these hurdles and streamlining the paperwork, the exchange is creating the conditions for a variety of new, actively managed products to finally reach the local market. Along with changing the rules for issuers, the exchange is expanding what these funds can hold. This starts by bridging the gap to the 9.2 trillion peso Philippine bond market. Bond ETFs will allow retail investors to buy and sell diversified debt portfolios in real time throughout the trading day, moving away from the slow, once-a-day pricing of traditional mutual funds. The integration also extends overseas. The proposed rules allow local ETFs to track foreign stock indices, which would let you invest in the S&P 500 through a peso-denominated fund. This allows you to hold international assets without the friction of wiring money to offshore brokerages or navigating foreign tax systems. Most notably, the exchange is preparing for the inclusion of digital assets. The new framework provides a regulated pathway to list crypto-based products directly on the local board. This shift turns the PSE into a multi-asset portal, where domestic bonds, international stocks, and digital assets trade alongside local companies in a single account. For this multi-asset system to work, the exchange needs an efficient way to manage trading activity. If investors can't buy or sell their shares instantly, the new products won't gain traction. To address this, the SEC is separating market makers and authorized participants. Previously, liquidity providers were burdened with the administrative task of creating ETF shares. By decoupling these functions, specialized trading desks can focus solely on keeping buy and sell spreads tight throughout the day. This updated plumbing is what allows the market to stay liquid. It ensures that when a retail investor wants to sell, there is always a quote waiting on the other side. For the average investor, this means your local brokerage account becomes a much more powerful tool. You can diversify into global tech, bonds, and crypto through a single, familiar interface. It removes the hidden costs of international investing, like high wire fees, and the risks of using unregulated exchanges without clear legal protections. These reforms are about access. They take wealth-building tools that were previously reserved for institutional players and put them directly into the hands of the public. The exchange is aligning its structure with new rules, preparing the trading floor for a new level of activity and a broader range of products. This shift changes the way you can build a portfolio from Manila. Are you planning to add these new asset classes to your strategy, or will you stay focused on local equities? Let me know in the comments. To see which specific companies are best positioned to benefit from this increase in market liquidity, click the video on your screen now. Thanks for watching, and I'll see you in the next one.